Thank you everyone for joining us for today's webinar. We are doing the 2022 market update. We'll be discussing the state of the economy, the current market, what to do to take advantage of the market now. As usual, these webinars are presented from the perspective of an accountant, an estate planning attorney, and a financial advisor. Today's webinar is presented by Yuri Yu, Donna Lee, and Sophia Kim Sakamoto. Yuri is a certified public accountant and her office is located in Fullerton, California. Donna is a certified financial planner and her office is located in the city of Orange. And Sophia is an estate planning, probate, and living trust attorney with offices in Buena Park and Mission Viejo. If you have any questions, go ahead and type them into the chat box below. We will answer questions at the end of the webinar, of course, time permitting. Please note this webinar is being recorded. Just a quick disclaimer, of course, it's just general information, right? We're not giving tax or legal advice and everything's copyrighted. So if you do need to make any screenshots, please let us know in advance. All right, so let's get started. Donna, everyone's curious, like what's happening with the market right now? Can you give us an update?
Isn't that the million-dollar question? I see a hand raised, Alfredo. Did you have a question or was this a mistake in raising your hand?
We'll just save the questions for the end.
Okay, yeah, feel free to type them into the chat box, as Sophia had mentioned, and we'll try to answer those time permitting. Okay. Well, yes, isn't that the million-dollar question? What's interesting is actually when we put together this presentation a couple weeks ago, the market and the economy and the sentiment overall was just so different than it is today. If you can all just think back a couple weeks ago, things were a lot more pessimistic, I think, than they are currently. So it has changed a lot in just a few weeks. This is just kind of like a snapshot of how the S&P 500 index has performed since 1996. You can see that it has its ups and downs, right? If you look at that last drop there, you can see that year to date, it's down about 14%. I just updated these slides with the July numbers. When I was looking at the June numbers, it was, I think it was negative 21. So it's recovered about a third in the last month, pretty much. But this is a reason why most people have been concerned with the economy, along with some of the news and the headlines with regards to inflation and such. But I want to specifically point out that if you look at February 19th, 2020, and then March 23rd, 2020, that's only 1 month time. 1 month time, that was when COVID hit. Well, initially when COVID hit, I guess, the market dropped 34% in 1 month. So relatively speaking, the fact that the market went down 14% in 7 months, it's a lot more palatable, but that one was a really sharp drop. And it really definitely gave us quite a scare, but we're kind of in that, it seems like things are stabilizing and it's starting to kind of go back up again. So we'll talk a little bit more about that. Next slide, please. I did want to mention that even though we live in the US, a lot of the news that we see, whether it's like CNN or Yahoo Finance, everything we read is about the US. We are in a global economy. And I just want to remind everyone of that really what we are experiencing here locally at home, when we turn on the news or when we go to the store, it's really being experienced across the world. If you look at 2022 year to date, if you look at all of these are pretty much red. Everyone is in the red, some more negative than us. Germany has had a rough year. China has had a rough year. Brazil has actually fared, decently well this year. But it's really not specific to the US at all. Next slide, please. The other concern is inflation, right? That's the one that we hear in the news. And actually, this is the one that really affects us on a day-to-day when we go to the grocery store and we buy milk, right? Or we buy food, or when we Uber Eats, or just dining out in general. things have gone up significantly, and it's really hitting our bottom line. So this inflation is significantly high. It is true, what we're hearing in the news. These numbers, like I mentioned, was just recently updated. So inflation in June was at 9%. That's astronomical. However, to put it in perspective, if you look at this dotted line here, the average rate of inflation should be right around 3 or 4%, about 4% or so. And if you look, most of the time, we're not near inflation. We're not near the average. We're below the average. In fact, we've been below the average for a number of years. And I think what it is it's just all of a sudden we're just catching up for it. We're making up for the fact that all the other years have been so significantly below the average that we're kind of just making up for it. You can see that the difference between the light blue and the dark gray. The light blue is the headline CPI number. That's the consumer, that's the inflation rate that you normally see. The core number, headline, this light blue number equals basically the core plus food and energy. Usually food and energy sometimes is stripped out of the core inflation because they're significantly higher, right? That's what we feel. Food is hot, is very expensive, and energy prices have gone up. But overall, it's up at 9%, which is more than double what the average is, and it's really just making up for the previous years. Now, people always ask me, is this here to stay? Is inflation going to continue? I do think that it would be very difficult for prices to go back down, only because if you think of it from a business owner standpoint, if you can charge $12 an item now for something that you used to charge for 10, are you ever going to go back down to 10? It would be very difficult to do so. However, I do see that the rate of inflation, the rate at which it's going up, is probably going to eventually taper off. And remember, this average is like a 40-year average. So we're just looking at this time frame in the last 6-7 months, and it's really a very small window in the grand scheme of things. Next slide, please. Feds and interest rates. This one is a little bit interesting. I'm sure, as a lot of you guys know, that the interest rates are in the news a lot. The Fed likes to manipulate interest rates. It's one of the tools that they have to use to manipulate the market, right? When the market is really, really good and they want to control it a certain way, they play with interest rates. When the market is really, really bad and they want to manipulate it a certain way, they play with interest rates. So generally speaking, when they're trying to fix the economy, they would lower interest rates. However, you can tell that, for a long time, we were at 0%, or very close to 0%. And so as the economy starts getting a little bit better, they want to increase the rates so that in the future, if the economy gets worse, they have that leverage. They have the juice to lower it down again, basically to help and stimulate the economy. So in a way, it's kind of a good thing that interest rates are starting to slowly go back up, because that means that the economy can withstand the interest rates going back up. Now, how fast it goes up is another issue. And this is kind of an art that the Feds will have to kind of play with and get. And we hope that they get it right each time. Is if it goes up too fast, it could shock the interest, right? The economy. The stock market usually reacts negatively and such. So there's a lot of it's like a chain reaction when they increase or decrease rates. So currently we're right at this 2.38%. And you can see the trajectory of where we expect rates to be. So the market is this green line, this light green line, and they're expecting it to be in the long term right in the 2.5-ish range. And then, however, the Feds see it a little bit higher. So we'll see what happens. Eventually, the long-term projection is right around 2.5%, and we'll kind of see, what it turns out to be. But the general consensus is that they are increasing rates at a certain point, and then they'll probably start tapering off, and we just don't know when that will be. Next slide, please.
All right, so Donna, that's a really good update kind of historically and where we are in relation to that. But of course, everyone wants to know, are we in a recession right now?
That's $1 million question. Okay, so the answer to that currently is no. So a recession generally means it's, you're considered to be in a recession when there's 2 consecutive quarters of negative growth in GDP. Okay. But it's not just the technical numbers. There's actually a lot of other factors that go into this. And it is usually, there is a nonprofit organization called National Bureau of Economic Research. They're the ones that announce whether we are in a recession or not. Okay. And then you hear the term bear market. Oh, we're in a bear market, right? So what is the difference between recession and bear market? Bear market is just when security prices fall, I guess 20% or so from the recent high, and everyone is negative about the economy, and there's a lot of pessimism. So it's kind of a loose definition. There's nothing technical about it. It's not like when certain indicators hit, we are officially in a bear market. And same thing with recession too. This actually surprised me a little bit. Even I, as a financial advisor, I always thought it was a strict definition. 2 consecutive quarters of negative growth in GDP is considered a recession. However, it may not be, based on whether this National Bureau of Economic Research announces it or not. So for example, technically we're in August now. So first quarter and second quarter, we did have negative GDP growth, but they haven't announced it that we're in a recession yet. So we're kind of like in that limbo. And in July, they've added more than 500,000 jobs in July. Unemployment rate has gone down to 3.5%, which is the lowest it's been since 1969. Gas prices went down, consumer sentiment is up, inflation has been lowered. So with all these other factors, I think it's really hesitating for that bureau to announce that we officially are in a recession. So there are a lot of other factors besides just the technical 2 quarters of negative GDP growth. So is that the next slide? Can I see the next slide?
There was just one slide for this section.
Oh, I see. Okay, yes, so there it was. Yes, so you can see right there, the first quarter was a negative 1.6, and the second quarter this year was negative 0.9. So if we go by that definition, then technically we are in a recession, but they have not announced it yet. Sorry about that. Okay, next slide. All right, so how does this downturn compare with previous ones? Next slide, please. So one thing we look at when we take a look at the stock market to see if it's overvalued as we look at their PE ratio. So what PE ratio stands for is price over earnings. It's, for lack of a technical definition, it just means frothiness. How frothy is the stock market right now, right? Is there a bubble going on? Are prices, good relative to how solid the company is? That's what PE is measuring. So the 25-year average for PE ratio is about 16.85 times. And you can see that now in July, we're right around 17.5. So we're right in range with what the standard PE ratios are, the averages are. It did come down from the peak, right? It was a little frothy. What that meant is that people were paying a lot more than they should for the stocks that they're buying. And that's why it kind of came down here. But we're right in line with what the average is. And so I don't necessarily think that we are in a worse state than previously. If you compare back to like the .com, if you look at the .com era, 1999, 2000, right, it was like at 24 times. And it was significantly higher. The PE ratios was significantly higher, but we're now much more close to the average. Next slide, please. Residential real estate. This is another one that people like to ask about and talk about. So as I'm sure you know, rates on mortgages have increased, right? We've been in like the 3s and 4s for a really long time, and all of a sudden it has gone up to 5 and even above 5 to get a loan. July, in July it was at 5.5. Although if you look at it relative to, again, the 40-year average, that's at 7%. So while 5.5, even 6% on a home loan seems really, really high and crazy in these times, just remember that the average is about 7%. And if you talk to those that are in their 60s and 70s, they remember days when in the 70s, in the 1970s or so, when mortgage rates were like 14% and such. So what I'm trying to get us to see is like not just where we are right now in our little window, but to kind of zoom out and see it on a grander scale on how we are relative to history, I guess. Home prices, high, not surprisingly. Everyone, I think, is aware of that. Home prices are high, inventory is low. In general, it is a seller's market. And again, this is as of July 31st. Things have changed a little bit since then in the last 2 weeks, but overall prices are high and it is a seller's market. And then if you look here, this is what a lot of people are concerned about, because you think back to the last recession in 2008, 2009, and real estate completely, bottomed out and all sorts of stuff. But if you look here, there's a lot of, this is the green bar. This tells you credit score. Most of the people right now, they're in the 760 plus credit score. So credit's not an issue. Whereas back in 2009-ish, it was much lower quality credit scores. Okay, so it's very different today as it was in previous downturns in the economy. Next slide, please. Consumer finances. So overall, consumers have lower debt at home now than they did previously. So if we look at this top right chart here, shows that on average, household debt service ratio is only about 9.5%. So this is much lower than it was back in 2007, when when there was a major bear market and a recession. So we have a lot less debt, which is good, right? That just means we have a lot more income, we have a lot less debt. Something that I found interesting was, if you look here, this chart is measuring personal savings relative to the pre-pandemic trend. So 2019, 2020 to 2021, this was COVID times. Everyone was working from home. There was a lot of government aid subsidies. There was PPP and all sorts of aid, government relief programs, and people were able to save a lot during that time. And then now that we're slowly coming out of COVID and such, we're actually in the negatives. However, I'm guessing that they're spending what they had saved previously. So this was kind of an interesting chart for me to kind of look at and dissect and interpret. Next slide on employment. Okay, employment and wages. So this is what I was saying earlier, how unemployment rate has gone down. Let's see, so the 50-year average unemployment rate is at 6.2, and we're at 3.6 in this chart. 3.6 as of July 31st, but the latest numbers I heard was 3.5, which is the lowest since 1969. So this is good. That means we have a strong workforce. Everyone who's employable is working. There's also wage growth. So we see that we've always seen the pressure for wage growth to increase, and it's right around 4% is the average, and currently it's at 6.4%. So it's definitely increasing. So these are all signs of a strong and healthy economy. More positive information. Next slide. So this chart, the first time I saw this I wasn't sure what I was looking at, to be honest, because there's a lot of lines, a lot of data, lots of numbers. But what this is saying is, okay, so the bottom line tells you is the year, is time. The y-axis here is the percentage, and the gray bar is telling you what the year-to-date returns were. And the red dot tells you what's the worst intra-year decline. So this is interesting because when we open up the newspaper or we look at like prospectuses and we look at certain investments, whether it's stocks or mutual funds or bonds or so, they always tell us what the performance is. But that performance is always starting January 1st. And most of us don't buy that investment on January 1st. We may have bought it, February 1st or January 3rd or December 30th, right? So it doesn't always apply to us. But yet that's widely used to report year-to-date numbers. So if you look at all these numbers, the gray bar is what it ended up at. So the January to December numbers. The intra-year, worst intra-year, is what those red dots represent. So you can see that the intra-year declines are always worse. Last year, for example, was considered a great year. The market went up 27%, right? That means if you started January 1st and you held it to December 31st, your account went up 27%. However, not everyone's account went up 27% based on what day they actually invested. The worst, if you pick the worst day to invest in the market, then you are down 5%, right? So it's just interesting to see this, but the way I read this is that you really need to have a long-term view on your investments, right? So if you're in this, in these red dots, don't worry too much. Don't necessarily make a move right away and immediately, trigger and sell, because you may be missing out. This year to date was 30%, and yet the worst time was -6. So if you just hold out long enough over multiple years, over time, your account should have more positive years than negative. Next slide, please. Oh, and this is perfect. This is exactly what I was saying. Okay, so these are numbers from 1926 to 2021. So we've got like 95 years worth of data here, okay? So what it shows you is out of these 95 years or so, 71 were positive years. And again, they're talking January through December. 25 years were negative years, okay? And of the years that were positive, on average, it was up 21.3%. Of the years that were negative, they were down 13.2%, okay? So again, this is a lot of numbers and a lot of data, but the way I interpret this is roughly 1 out of 3 years is going to be a negative year, okay? So if you're in the market for 3 consecutive years, 1 out of 3 of them are going to be negative, 2 out of 3 will be positive. And of the positive years, the average would be about 20% a year. And the one that's negative would be about negative 13% a year. Okay, so you can see that over time, right? If you're up 2 and down 1, up 2, it's never that consistent, right? It's never up 2 and down 1 and up 2. It doesn't work that way. It could be multiple years at a time. But in the long history of things, if you're looking back, this is what the averages tell us. And you can see how the economy and how the stock market will grow over time.
Yeah, so I think you're showing us that historically, right, it's generally on the positive side. Right now, maybe we're going through kind of a downturn a little bit, but it's bound to go back up at least sometime in the future. We just have to stay the course, right? But for this time, what are some things that we can take advantage of right now while the market's kind of down?
Yeah, great question. So all that information I gave, it was like the most heady information, all these numbers and all these slides. So how does it actually translate to my life, right? How do we apply all these charts and apply it to your personal finances, your personal situation? So a couple of things. First one is IRA conversions. This is a great idea to consider. Definitely something to bring up to your financial advisor or your CPA if they have not reached out to you to talk about this. You can convert your IRA in a bear market when the market is lower, and it is better. Why is it better? Think about if you had an IRA. Again, remember, IRAs are pre-tax, so you have not paid taxes on it yet. Roth IRA is post-tax. You will pay taxes on it when you put it in. So let's say you had an IRA for $10,000. Well, now the market has dropped. So your $10,000 IRA is now worth $8,000. And let's say you did a full conversion. You move that entire $8,000 over to the Roth. You're going to get a 1099-R on that $8,000 only. They tax you on the amount of dollars that are being converted, right? So if you had done this IRA conversion, 10 months ago, you would have had to pay tax on 10,000, whereas now you only have to pay tax on 8,000. So it is something to consider if you are planning on converting your IRAs, and this is something that you've been, thinking about. This is a good time to do so.
Donna, I know that with Roth, there's some like income limits. Does that apply for conversions?
No, it does not. So that's a good question. So there are income limits. There's a couple of different, rules when it comes to whether you qualify to contribute into a Roth IRA or not, but none of those apply here. Conversions, anybody can do a conversion. Does not matter if you're working, if you're not working, doesn't matter if you're making $1 million, doesn't matter if you're making $100. Anybody can do a conversion. The only thing is whenever you convert, the amount that you actually convert, the dollar amount that gets converted, is added on to your income tax. Okay, so that's the only difference. So you may want to, this is why I say it's a good idea to make sure you talk to your financial advisor or your CPA about this, because we don't want to we don't want to bump you in a higher tax bracket or make you pay a lot of taxes if, let's say, next year you anticipate your taxes to go down. So there are a few exceptions where it's not ideal to convert right now, despite the opportunity in the market. So it is individualized, but generally, all else being equal, it's definitely something worth considering at this time. Okay. Contributions. So let's say you are going to contribute into your 401k, right? You're going to do the max, 20,500. If you're under 50 this year, that's the maximum, and you plan to do it every year, you are already going to contribute, right? Well, make sure you contribute and just spread it out. Instead of putting in 20,500 all at once, for example, spread it out over the course of a few months or over the year, just because you don't know if the market is going to go down some more. Maybe it'll go up, we don't know. We basically don't want to time the market. It just takes out the element of potentially timing it at the wrong time, okay? And also stay the course. This one I think is a big one. It's really hard to, because human nature, we are by nature, we see something that's happening and it's not good for our accounts. We want to stop, we want to take it out, we want to stop the pain, right? But when we look at, these numbers and these charts and such, we know that with our heads, we need to stay the course. So there is that constant battle between what our head thinks and what our heart says. However, just remember, why did you invest in the first place? Why did you open this retirement account? Why did you open this college account for your kids? Why did you open this brokerage account? Was it just to have more money? No, it's not. There's a purpose behind that, right? You want this account because you want to be able to retire someday. You want to be able to send your kids to college and not have to worry about the tuition every quarter when time comes. You want to upgrade your home or remodel your home or whatever for your family, right? So remember the motivations behind why you opened the account in the first place. It's more than just so I can have a bigger number on the statement. There's a purpose behind that. So if you keep that in mind, the goal of why you actually opened the account in the first place, it helps you feel a little bit better with the day-to-day volatility that's going on in the market and all the news and such. The other thing is maybe just turn off CNN and Yahoo Finance and such. And lastly, this is actually my favorite because I like to travel and I haven't in a while because of COVID. But when, in the event we end up being in a recession, when they call it, officially that let's say we are in a recession, it's a good time to take a look at your expenses, right? As long as you have the means to do so. A lot of the things that would be considered luxury in normal days, right? Disneyland tickets, traveling, vacations and such, those are usually the first to get cut. Right? For most families, you're not going to be taking vacations anymore. You just want to make sure we're in a recession. I got to make sure that I have food on the table and I have a roof over my head. But those are the first things to get cut. And guess what? Those prices start coming down. I remember in 2009, when things were really bad, Disneyland annual pass to Disneyland was $144 for the entire year. That is amazing. It'll never be that again. But they did that because the markets was so, everyone was fearful. We were in a recession, housing prices, all sorts of stuff was going on, and everyone was cutting luxury items, and Disneyland was like one of the first to go, right? So that is something I would consider if you have, if you are blessed enough and have the means to do so, consider, those are the luxury items that you're able to do at a discount. The other thing right now is it's very strange, but for whatever reason, US currency is very strong right now, especially against the euro. Historically, it's like one to 1.5 or 1 to 2 even for euros. But it's almost 1 to 1 at this point. So, if you're blessed enough and you have the means to do it, or this is definitely a good time to look outside the country and spend those US dollars that's worth a lot more.
Donna, is there anything that you would say not to do in a bear market right now?
Yes, I think the biggest mistake people make in a bear market, and this is the hardest thing to do. Remember how I said it's basically like your head versus your heart? So I think the biggest mistake to do in a bear market is to cancel everything you have and to close out your account. I think that's going to be the worst thing to do. Of course, everyone's situation is different. If there's a reason why you're doing it, because you have XYZ going on and it has to be, right? Talk to your financial advisor, CPA. It is what it is. But if it's just because it's out of fear, then I would say, talk it out with those professionals, but that would probably be the worst mistake to make because you're realizing a lot of those losses. And, you got to realize that timing goes both ways. If you take the money out right now when it's down, you also have to know when to put it back in. For those people that take it out when the market goes down because they're really scared, they'll probably miss the gains. So it won't be until after the market goes back up, then they feel better and then they put it in. But then they basically just did what we tell people not to, right? We want to buy low and sell high, but they just did the opposite. They just sold low and bought high. So that's probably the worst.
So maybe like buy the dip is good.
Yeah, if we knew for a fact when the dip is, then yes. But because we don't, my second option up there is to spread it out. So you want to buy and spread out your buys basically. So you have multiple entry points into the market.
Right. And then of course, because interest rates are a little bit higher, don't do a refinance, right? Generally.
Yeah, all else equal is probably not the best time to do a refinance just because rates are higher. But I'm sure there's a reason why you would even consider a refinance right now anyway. So that has to obviously be more important than the fact that rates are up.
All right, great. So now, Yuri, a lot of this is just historical in the markets, but how does this affect my taxes?
Yeah, so as Donna mentioned, if you are thinking about converting some of your pre-tax retirement accounts to a Roth IRA, now is a good time, partly because the market is down, but also because tax rates are low right now. And these low tax rates are set to expire in 2025. That means in 2026, tax rates are going to increase back to pre-2018 levels. So most tax rates will increase about 3 to 4%. And remember that the benefit of having a Roth IRA is that the growth in that account is tax-free. And it's not just tax-free to you, but it's also tax-free to your beneficiaries. So if your children inherit this IRA in the future, they're not going to have to worry about paying tax on the distributions that they take. So when I kind of think about it that way, it's a little bit different. When I think about it just for my own personal situation, it's like, oh, I'll just pay tax on it later. But when I think about, oh, if my kids inherit this later, they're going to have to worry about the taxes. And so that kind of helped me like switch my thinking a little bit. The other thing I wanted to mention is capital losses. If you have a lot of capital losses, just be aware that there is a limit to the amount that you can deduct each year. Your capital losses can offset your capital gains. If you have more losses than gains, then you can deduct up to $3,000 on your return. And the rest of the losses are going to carry forward to deduct in future years until they're used up. You cannot carry them back, and you cannot offset other income other than that $3,000 limit, annual limit. On the other hand, if you have a lot of capital gains, then you may have heard of a strategy that people use called tax loss harvesting. This is where you sell stocks at a loss to offset your capital gains. And it could be a good strategy, especially if you have a lot of short-term capital gains, but it's not always the best strategy for everyone. So there is some like tax rate planning to consider here. You also want to watch out for wash sales. This is when you sell a stock at a loss and then buy it back within 30 days before or after a sale. That loss is not allowed. So if you do plan to buy it back, just make sure to wait until after 30 days, like 31 days. And at this time, wash sales don't apply to virtual currency. That could change at some point. It was even included in one of the prior tax bills that didn't get passed. But as of right now, you can do wash sales on crypto. And remember, just because the stock market is down, that doesn't necessarily mean you're not going to have taxable activity in your accounts. You may still have interest income, dividend income, or capital gains, just depending on what you're invested in. So, you know, these brokerage, these investment accounts, they're different than retirement accounts in that all of that activity that happens within the account is taxable, even if you didn't like actively do any trading or take any cash out of the account.
So you're saying that even if there's like a loss, there still could be a 1099, so wait for that?
Yes, if you have a brokerage account, you're probably going to get a 1099. I know a lot of times people are eager to get their tax refunds or eager to file their tax returns. So they're like, oh, I didn't do anything in the account, I'm probably not going to get 1099. And then of course, 5 days after we e-file the return, there comes the 1099. So it's always best to just wait just to make sure that there's nothing else, because those 1099s are reported to the IRS. So anything that's on there, IRS is going to look for it on your tax return. Okay, so other changes so far this year. In July, Governor Newsom signed a bill authorizing tax refunds of up to $1,050 for California taxpayers with adjusted gross income of up to $250,000 for single filers and $500,000 for joint or head of household. The payment amounts are based on your 2020 tax return. They're going to start issuing these payments in October via direct deposit, or they'll mail you a debit card if they don't have your bank information. You can find more information on this refund by going to the website, stb.ca.gov. There's a link right at the top of the page. It's going to provide more details about this refund, and there's a refund calculator. IRS increased the mileage rates. These are the business mileage rates. It went from 58 cents to 62 cents, just you know, in reaction to the increased gas prices. So if you do use your car for business, you're going to have to split your mileage through the year. Just make sure you keep a detailed mileage log because you will need to report on your return mileage from January 1st to June 30th and July 1st to December 31st. IRS recently released a draft of the 2022 individual tax form 1040, and they've updated the question regarding virtual currency, basically expanding their definition of the word receive. Since they've added this question a couple of years ago, they tweak it like every year, which I think just shows that this is an area that they're continuing to pay attention to. For the most part, if you answer yes to this question, then somewhere on your tax return, there should be a taxable virtual currency, you know, transaction being reported. So if you do hold virtual currency, make sure you keep good records and report all of your taxable transactions. And just a few days ago, the president signed the Inflation Reduction Act. There's actually not that much in there that will directly affect the taxes of, you know, the average person, especially when you compare it to some of the earlier versions of Biden's tax plan. One area that has gotten a lot of attention is that the IRS will be getting increased funding of about $80 billion. They say this will be used to increase enforcement, improve their operations, improve their customer service, and modernize their very, very old computers. So hopefully this will improve the level of service they provide, because it has been so difficult to resolve tax issues over the last few years, even just the most minor things. I know there is some panic about whether, you know, IRS are going to come out guns blazing, you know, auditing everyone. I don't know. It's not something that I'm really worried about. It's going to take them years to recruit and hire and train employees and update their computers. So I'm hopeful that the changes will be positive because I just don't feel like it could get any worse at this time. And there was also a bunch of green energy incentives with increased or expanded tax benefits for things like energy efficient home improvements like solar panels, electric vehicles. We're still waiting on guidance on how all of this will be implemented. But if you are planning to install solar panels or purchase an electric vehicle, you could, it might be better for you to wait until 2023. It might be better to wait until January. But we're still kind of waiting on guidance. So we'll just have to wait to see how everything shakes out.
All right, and just a quick note, there was some changes in July for Medi-Cal asset limits. So if you didn't, if you or maybe your parents hadn't qualified for Medi-Cal based on your assets, you might want to take a look again. They changed the rules in July. Donna, we have time for one question that came up in the chat. And I know that you were talking about just the recession and the downturn. This month, we did kind of see a little bump up. But do you foresee another recession or another, market downturn, maybe worse? What are your thoughts on that?
Maybe instead of another recession, I guess the bigger issue is, are we going to see a recession with what we're currently going through right now? We're kind of like in that limbo stage where, some of the qualifiers we check the boxes for, and then some others we don't. So we'll see. President Biden actually came out and basically said, there's no way we're in a recession right now because of all the things that I had mentioned. Unemployment numbers, inflation's gone down, gas has gone down, all hunky-dory things going on in the market. So I don't know what will happen with, the current situation. In terms of the market downturn, I'm going to say this with a grain of salt because I can't predict and foresee the future. But I will say that I have a hard time believing that the worst is not behind us. I do think that the worst is behind us, and we're just going to kind of yo-yo. There will be some up months like this last month. It's very possible that we'll have some more down months, but I think it'll just kind of like yo-yo there for a while until the next big thing. I don't know, maybe more interest rate adjustments and such.
Yeah, I mean, you did mention that it was a little bit different, the circumstances, than like the 2008 time. All right, well, thanks everyone, and Donna and Yuri for presenting today. And thank you all for joining us. We know your time is valuable. We strive to provide content that is informative and helpful. Our next quarterly webinar will be in November, so mark that on your calendar. And as usual, it will be tax-centered with tax updates for the year and what you can do before the year ends, again, from the financial standpoint of tax, investment, and estate planning perspectives. If you missed any webinars, they're all online on our YouTube channel. A feedback form is going to be emailed to you, so please let us know any comments and any suggestions for future presentations. Thanks, and join us again next time.